The recent broad market crypto relief rally seemed to promise a unified return to bullish conditions. Then, the momentum shattered. Entirely without warning, the market abruptly fractured, with high volatility assets stopping dead in their tracks. When price action halts without external triggers, the cause is usually structural. The upward momentum collided with localized, downward-pressing dynamic resistance, invisible ceilings built by the market's own recent history. To map these invisible ceilings, we use the exponential moving average, or EMA. Unlike a simple average, an EMA applies more mathematical weight to the most recent price data, making it highly responsive to sudden shifts. Looking at this animated chart, we can see what happens when multiple moving averages converge. They form an EMA cluster. These layered lines create thick, formidable bands of resistance. When a V-shaped recovery runs into a wall of downward-sloping EMAs, the price immediately stalls. Mapping these interactions reveals an important reality. There is no single, unified market trend right now. Instead, the market has fractured into three highly distinct structural archetypes. Every major asset currently falls into the geometric suppression phase, the reversal phase, or compression phase. Identifying which phase an asset is in requires looking beyond the price itself. We have to cross-reference the geometry of the EMAs with actual trading volume and the relative strength index, or RSI, a metric tracking speed. Evaluating which of these three structural archetypes an asset currently occupies provides an objective, probabilistic method to forecast its next directional move. The first archetype is the bearish trap. To see how this functions, we look at Dogecoin and Cashcat. Both assets are stuck in a severe suppression phase. This layout plots Doge and Cashcat against their trends. Notice the defining trait. Price is trapped beneath the 20, 50, 100, and 200-day EMAs. All four lines slope downward, forming a widening cluster of overhead resistance. This thick red band confirms absolute seller control. This structure creates a psychological trap for retail traders. The trap is sprung by the relative strength index. Following a sharp decline, the RSI will naturally bounce out of heavily oversold territory. An RSI recovering to the low 40s signals that aggressive selling has temporarily exhausted itself. It does not mean buyers have actually returned. Identifying a genuine reversal requires looking at trading volume. Cross-referencing price with trading volume reveals the conviction behind the move. Look at Dogecoin's recent sideways consolidation between 7.1 and 7.8 cents. As the price leveled out and the RSI improved, the actual trading volume steadily decreased. Market participation simply dried up. This establishes the principle of volume-validated RSI. When an RSI recovery occurs alongside declining trading volume, you are looking at passive stabilization. Buyers aren't accumulating the asset, sellers just momentarily stepped back. Assets trapped in the suppression phase lack the volumetric foundation required to breach heavy resistance. Without active accumulation, they remain structurally vulnerable to new macro lows. The structural antithesis to the bearish trap is the momentum reversal. Ethereum's recent price action provides the perfect blueprint for this second archetype. Here is the requirement for a true reversal. Ethereum must break above the short-term 20 and 50-day EMAs. Piercing these averages flips their polarity from a ceiling to a floor. As price dips, these newly green lines absorb selling pressure and push the asset higher.
The key differentiator here is the volume data. Ethereum's breakout over these averages was accompanied by a clear, measurable expansion in trading volume. This high volume participation proves institutional involvement. It stands in direct contrast to the low volume, passive stabilization we analyzed in the bearish trap phase. This genuine volume correlates directly with a healthier RSI. Ethereum pushed its RSI to 63, a reading that indicates strong upward momentum without crossing into the dangerous overbought exhaustion zone. Higher price targets must still contend with the 100-day EMA. For Ethereum, this sits near $1,944, acting as an active resistance barrier that immediately caps the rally. This creates a dense resistance cluster between $1,950 and $2,000. Breaking this final threshold is mathematically required to confirm a macro trend reversal toward the ultimate target, the 200-day EMA. A reversal phase establishes its structural legitimacy when local resistances are definitively flipped to support on high volume, proving that buyers are willing to step in at higher prices. This brings us to the final, most structurally explosive archetype, volatility compression. We can see this mechanic actively developing in Stellar, or XLM. Stellar trades inside a tightening moving average cluster. On the bottom, the 20 and 50-day EMAs form a rising floor, defending 19 cents. Simultaneously, resistance presses down as XLM contests the 100 and 200-day EMAs near 20 cents, forcing price into a shrinking pressurized wedge. The market psychology driving this tight formation is healthy. Following a massive rally in May, the asset has spent weeks absorbing its gains horizontally. It is refusing to surrender ground and retrace sharply. Because the price has moved sideways for weeks, the RSI has cooled off completely. It rests at a perfectly balanced neutral reading of exactly 51. A neutral RSI inside a compression zone is highly advantageous. It means the asset is fully reset. It has maximum runway for momentum expansion, regardless of which direction the break occurs. Volatility compression cannot last indefinitely. The converging moving averages function like a vice, eventually forcing the market to make a high-velocity directional decision. For analysts, this makes it the highest priority phase to monitor. A macro market recovery rarely moves in unison. Initial synchronized momentum quickly gives way to structural divergence, as assets conform to their specific geometric realities. Relying on general macroeconomic sentiment to predict these moves leaves you blind to the internal mechanics. Mapping dynamic resistance using moving averages provides the actual blueprint of the market. We evaluate charts through 3 frameworks. In the bearish trap, downward sloping resistance clusters dictate the trend, rendering minor RSI bounces meaningless. In a momentum reversal, short-term moving averages flip into foundational support. In volatility compression, tight clustering builds kinetic energy before explosive expansion. Apply this logic to the assets you track. Evaluate the slope, the density, and the polarity of the dynamic resistance layers surrounding the current price. Advanced charting serves as a method for measuring actual trading momentum against hard structural resistance. Market geometry dictates market reality. Categorizing an asset into one of these 3 structural archetypes provides a data-driven framework for navigating the risks of a stalled recovery.